Stock Market Education Series Video Number 3. How to Analyze Stocks Before Investing. Welcome back to our Stock Market Education Series. So far, we've covered what the stock market is and how stocks work. But before you start investing, it's critical to know how to analyze stocks properly. In this video, we'll break down the key factors you should consider before making an investment decision. Let's get started. There are two main ways to analyze stocks: fundamental analysis and technical analysis. Each serves a different purpose, and understanding both can give you a better edge in the market. Fundamental analysis is about evaluating a company's financial health and overall value. It focuses on business performance, financial statements, revenue, profits, and company growth. Investors use this method to determine if a stock is undervalued or overvalued. Technical analysis, on the other hand, looks at price trends, trading volume, and historical data to predict future stock movements. Instead of evaluating a company's financials, technical analysts rely on chart patterns and indicators to make buying and selling decisions. Let's start with fundamental analysis. To truly understand a company, you need to look at its financial statements. There are three key reports every investor should analyze. The income statement shows a company's revenue, expenses, and net profit over a specific period. It tells you how profitable a company is and whether its revenue is growing. A company with consistently increasing revenue and net profit is often a sign of good financial health. The balance sheet lists a company's assets, liabilities, and shareholder equity. This report gives insight into how stable a company is financially. If a company has more assets than liabilities, it means it has a strong financial position. If it has too much debt compared to its assets, it could be a risky investment. The cash flow statement tracks how money moves in and out of a company. A company can be profitable on paper but still struggle if it doesn't generate enough cash flow to sustain its operations. Positive cash flow means the company has enough money to cover expenses, invest in growth, and pay shareholders. When analyzing a stock, pay attention to key financial metrics that can help you determine whether it's a good investment. Earnings per share, or EPS, measures how much profit a company makes for each share of stock. A higher EPS usually indicates strong profitability. Investors look for companies with steadily increasing EPS. The price-to-earnings ratio, or P/E ratio, compares a stock's price to its earnings. A lower P/E ratio may indicate a good value, while a higher P/E ratio suggests that investors expect high growth. Comparing a stock's P/E ratio to others in its industry can help determine whether it's overvalued or undervalued. The debt-to-equity ratio measures how much debt a company has relative to its equity. A high ratio means the company relies heavily on debt to finance its operations, which can be risky during economic downturns. Lower debt is generally safer. Return on equity, or ROE, shows how effectively a company is using shareholder funds to generate profit. A higher ROE suggests a well-managed company with good growth potential. Even a strong company can struggle if it operates in a declining industry. That's why it's important to analyze industry trends and competitive advantages. Companies that dominate their industry or have unique products, brand power, or technology tend to perform well over time. When evaluating a company, ask yourself, is it a market leader? Does it have a strong customer base? Does it have a competitive edge that will help it succeed in the long run? Companies like Apple, Amazon, and Tesla have maintained strong positions in their industries, making them attractive long-term investments. Now, let's move to technical analysis. While fundamental analysis helps you identify good companies, technical analysis helps you find the best time to buy or sell a stock. One common technical indicator is moving averages. A moving average smooths out price fluctuations over time to identify trends. A stock trading above its moving average may indicate an uptrend, while trading below it may signal a downtrend. The Relative Strength Index, or RSI, measures whether a stock is overbought or oversold. If RSI is above 70, the stock may be overvalued and due for a pullback. If it's below 30, the stock may be undervalued and a good buying opportunity. MACD, or Moving Average Convergence Divergence, is another powerful tool that helps traders identify momentum shifts. When MACD crosses above the signal line, it could indicate a buy signal. When it crosses below, it may suggest a selling opportunity. Before investing, go through this simple checklist. Have you analyzed the company's financial statements? Are you comfortable with its industry and competitors? Have you checked key financial metrics? Have you used technical analysis to time your entry? Are you investing for long-term growth rather than speculation? Now that you know how to analyze stocks before investing, it's time to learn how to manage risk and build a strong investment portfolio. That's coming up in our next episode. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update. Tell us in the comments, what stocks are you interested in analyzing? Let's discuss. Thanks for watching, and we'll see you in the next video.